Looks like we're good to go. All right. Good morning, everybody. Welcome back to Engineering the Markets. Happy Monday. Hope you had a great weekend, rest and relaxation away from some of the market volatility that we saw last week. And as always, let's get things started. My name is Jared. This is April 25th, 2022. We're looking at the tail end of the April month. We're obviously getting into a really jam-packed earnings week amidst the larger earnings season that we've been involved in over the past 2 weeks. We've seen the banks come out with earnings. We've had a couple of odds and ends last week. And then, of course, this week is going to be a lot of the heavy mega market cap, usually tech, consumer discretionary, and communication stocks that are going to likely have some impact on the market. So let's start off this week, as we always do, nothing out of place, and talk about last week's expected move. Now, if you recall, last week, we're looking at the expected move from the April 22nd option series, and the market was pricing in approximately a $98 expected move. Now, remember, this is always from the previous Friday's close. And when we're looking at this expected move, we're talking about plus or minus. So the market can obviously move higher and lower, give a more just dramatic range overall. So long as it's closing within that expected move, the option market is pretty much right on the money. And usually what we can say is if the market has breaches and tends to move back within the expected move range, we call that overextension or just a move into a risk level, and the market can often pull back in, usually closing somewhere in between that expected move range. So whenever we look at some of these metrics after the fact, things like the actual move, what I'm looking at here is how far did the market move from the central point at its most extreme? What was the widest breach is another way to kind of think about it. And if the market stayed within, then of course this percentage stays under 100%. But as we know, the market did have two breaches last week. We saw one to the top side, and that expanded up to 45.12, 45.13 in the SPX. We also had a downside breach that occurred on Friday. Not only did we breach, but we closed outside of the expected move, which we'll talk about in just a moment. That downside breach expanded all the way to 42.67. So that gives us our actual move last week, which was about 123% higher, or 123% of the expected move total. We obviously had a little bit more than the 98-point movement. Now, what's more important last week is obviously the up and down volatility. Normally, we don't talk about this too much on this particular view of the market, but it's worth mentioning because the market did a full 180 from top to bottom. We obviously had that upside breach on Thursday. Market hit that 4,500 sort of technical and psychological level, completely reversed. And as you can see, just looking over the past couple of days, not only did the market sell, but the selling was pretty much straight down. We really didn't have any sort of ranges being established on the way down. Most of the time, things like the 5-minute trend never really changed back into the favor of the bulls. And a lot of these bounces were obviously sold into and made fresh lows until we got to the lower bound of the expected move for the week, which occurred near the end of Friday's session. So the full range of this move, because it is representing the top and bottom, was about 245 points. Now, why is this important? Well, as we saw last week, the market not only made such a significant downside move, but it did so with volatility expanding. So as we are looking into this week's expected move, this is going to be the week ending on April 29th. We're looking at a weekly expected move that is significantly higher than last week's. You'll note that it's actually higher than the actual move we got last week from central to bottom, the full breach from the central line. And then, of course, if you look at last weekly's range, it's indicative that the market is trying to prepare for this type of volatility going into the earnings season that we're about to hit, or the earnings week that we're about to hit. Now, this earnings expected move puts our top side level at about 4406. This is where the option risk is defined in the market to the top side. But more importantly, since we are looking a bit bearish overall, we're looking at a downside level of about 4137. And what I often like to do is just keep these prices in mind, especially when they are technical and have some impact relative to previous price action. So for example, if we look at where this particular expected move lands us, puts us pretty much in line with the absolute low that we have back in February. So can the market test this level? Certainly. The option expected move is indicating that this would actually be fairly normal for the week. If we tested it and came back in, that would actually be within expectation. But what it also means from a technical sense is that most bullish market participants over the past couple of months will be down on the S&P. At some point, they will experience sort of a negative drawdown. And that, of course, incites fear, a bit of uncertainty, and typically even higher volatility, depending on how fast we get down to those price levels. So this is what we are expecting for the week. It is not based on any sort of bias or anything of opinion. It's simply what the option expected move is telling us. And by using this quantitative approach, we get a sense of, one, what sort of price action can we anticipate if we are inside, outside, and testing things like the expected move bounds, along with understanding that if the market were to move in wide strokes between, let's say, these price ranges, then overall the option market would say that that's normal. That's basically within the normal standard deviation of movement for the week. And as a trader, you should not be surprised by that either. That's the goal here, is to remove some of the uncertainty from the market and obviously give it some quantitative data to support those thesis ideas. So first and foremost, let's shift into what happened with volatility last week. I'll start off here just looking at the volatility futures. It's where the conversation will lead anyway, but you can obviously look at the VIX and say, yeah, the volatility went up last week. Notable shift in who's in control from a volatility perspective. We're looking at, that relative support around the 20 print on the VIX. This is indicative of an inflection point to see larger moves occur from these price levels. Even if you get slight breaches to the downside, that's usually they usually reestablish at inflection points and typically move, whether it be towards or against the inflection. You'll also note that I have 30 marked. So, I could go ahead and mark 20 really quickly. It's not going to be perfect, but I also have 30 marked. The reason being is, while this is not necessarily a resistance point for the VIX, it tends to once again be a significant inflection point. And usually what you're going to see is the market is going to change dramatically if we start to expand higher than 30. For one, if you note previous price activity above 30, these are some of the most volatile S&P sessions that we've seen in quite a while. You're looking at things like some of the December volatility right before the relative topping action in the S&Ps. We're talking about Jan lows. That's that high capitulation low that the market experienced. And then you're also talking about a period of time in February. This is actually a point where the S&P remained elevated in volatility, and we were talking significantly about volatility being in backwardation. So that point in time in the market where volatility remained elevated above 30 as sort of a talking price level, that is an important point into how the market will trade. And usually what that gives us is an idea of risk. Higher volatility markets typically have wider ATRs. They typically move much more significantly on an intraday basis. You're going to see usually not necessarily a trending day, but you'll have wide expansions, and on reversals, you'll actually have significant bounces. Just knowing where they are and obviously trading them successfully is another point entirely. So keep this 30 point in mind. You know, the VIX right now is kind of topping out in the moment around the 30 point. And also note that this is a big inflection point for some of the downside we saw. You can almost argue that the trending activity on the VIX in February ended whenever we broke down below 30. We almost fell, back tested, and then came off precipitously from that 30 point. Now, when we look at VIX, we're looking at volatility futures inherently. And what we want to talk about here is the term structure. Once again, just going back to what we already know works in this market. For one, last week, we saw a massive rally inside of volatility futures. For one, they were actually sitting curve-wise fairly normal for the last couple of sessions. So if you'll give me just a moment here, let's say we're looking at volatility futures. We're looking at the curve structure here, and we're looking across basically the next couple of months. You know, I could take off some of the tail end here. Just look at maybe the next 5 months of volatility contracts. If we start last week on the 20th, which is the Wednesday session, you'll note that the curve here is fairly normal. We're looking at a rising volatility curve, which means short month volatility is priced lower than back month volatility. That continues pretty much throughout until you get to October, and then you get a slight tail end near the back. Pretty normal. I'm going to bump this up by 1 day. And what you'll notice here is, once again, we're seeing some rise in volatility, but the curve is still normal. Higher volatility readings in back contracts. Now, once again, you know, you can see volatility expanding, but so long as the term structure remains normal or in contango, that's simply indicative of an expanding vol, but not necessarily the type of fear or, let's say, volatility hedging that we're likely to experience now. And then I'm going to shift it over into Friday. So Friday is pretty much when everything changed. We saw that not only are we seeing the higher volatility readings, we're looking at 28 for the May contract, but notice how these months are starting to get flatter and flatter. Basically, we're no longer looking at that nice, simple curve. We're looking at things coming into the same relative pricing. You want to think about this in a similar way to what we've talked about with interest rates. You know, the structure here is what's important, not necessarily the pricing that is a part of it, but if you have higher prices in future contracts or back month contracts, not only has the term structure flipped, but it's indicative that the market sees more fear and more volatility, more risk earlier than it does in future months. The pricing model has changed, and that can cause a lot of whipsaw, a lot of very erratic trade, along with, in this case, it's indicative of risk. It's where does the market see the most risk moving forward. So this is on Friday. I'll move it now to today. This is where we sit today. You'll notice that everything is pretty much flattened out. We're talking about maybe 5 to 10 cents per contract, but most of our short month contracts are flat at this point. This is one way to visualize what I often show here in regards to our active contract at about 28.70, our June at 28.72, 28.90. You're basically seeing the same pricing. So we're flat right now. Does this mean that we're immediately going into backwardation? Not necessarily. What it means is that over the past couple of days, there's been a dramatic move to get this into a flat structure. We started off very normal in, construction, and we've gone immediately flat. It's been very aggressive and quick, the speed of this movement. Now, if we were to go into backwardation again, and I say again because we've been here before, we've seen what the market looks like whenever the market goes into backwardation. You're going to see typically trade that looks more like this style, where you're going to have very wide S&P movement back and forth on an intraday basis. You're also going to see some odd characteristics from an intraday perspective. For one, if you recall, some of the most bullish days in the S&P on an intraday basis occurred on gap down opens. Basically, the market had some of the strongest bounce rallies whenever we were opening weak. Similarly, whenever the market had a gap up open, we often saw some of the largest sell-off days in terms of just relative range. Market would top out and then pretty much never see any sort of continuation bounce for most of the session. It also shows that a lot of this trade tends to not necessarily be expansive. And what I mean by that is we're not really seeing a lot of trend from, let's say, day to day or even some sort of weekly posture. I'm kind of marking off these areas where the volatility was high. You'll note here, this is the February to March volatility expansion. That was when we were trading above a 30 VIX for a period of time. And what's important here is that, yes, there were some days that went higher. There was this massive inflection that we got, typically centered around the Russia-Ukraine news cycle. But ultimately, there wasn't a trend to focus on. The market had a general downtrend feel. And of course, we did break out here on some Fed-related discussion. But ultimately, the back and forth trade was centered around these key prices. You saw some up days, some down days, lots of false breakdown lows, lots of false expansion highs, many days of back and forth as the volatility settled and ultimately came off near the tail end of that move. So all in all, what I'm trying to reiterate here is that we're not quite there yet. We're not in that period like we were in February and in March, or sorry, in January and in February. But everything about this move is indicative that we could be headed there. It happened very quickly. It was only 2 days to go from normal to flat. Can we see that continue? Well, the earnings season is probably going to be our guide. And I'll bring up our trading terminal just to show how jam-packed this week is for those who maybe haven't seen the earnings up to bat this week. So some notable names this morning. We have the likes of Coke, and we also have Activision Blizzard. Keep in mind that Activision Blizzard does have a acquisition price inside of its stock pricing. So that one has not really been in play for a period of time, albeit its earnings are coming out this afternoon. And then as we move into Tuesday, Wednesday, and Thursday, this is where a large portion of the activity will be. We have the likes of Microsoft, Google or Alphabet Company, and even Visa. Keep in mind that this is still a tech company by its sector grouping. So, Visa represents a good portion of the tech sector. It also represents a little bit of consumer spending. How well is the consumer doing? Are they continuing to be sort of fueling the economy? And in Visa's case, what sort of credit to debt ratios are we kind of dealing with? That can obviously be seen on a much larger scale, not just necessarily company-wide. You also want to keep in mind other companies, UPS, Ray, one to get a sense of, once again, that consumer spending and also just relative shipping performance. Has that company been doing well? 3M, Triple M, a lot of people say, great industrial company, tends to be more of a conglomerate in the industrial space and a lot more centered on, I'd say, like basic goods in regards to companies. You're going to be thinking things like office supplies and also building some potential airliner parts. They are a conglomerate, so they have their hands in a lot of different cookie jars. But this company, another one to kind of keep an eye on, might also be worth listening to their guidance along with their perception of future outlook. And then as we move forward, the likes of Meta, Qualcomm, PayPal, some of these are going to be good traders, but some of them more indicative of market cap performance. The likes of Meta for Wednesday, our biggest one. And then finally on Thursday, this one's going to be the big one, the likes of Apple and Amazon. Now, from a market cap perspective, there is no one bigger than Apple. Apple's our heavy hitter, but Amazon as well. These are both pretty much the top tier companies in regards to tech and consumer discretionaries. So how they perform, the expectation of movement, and also the actual beat or bust from earnings and the move that occurs thereafter. These are all things that are going to shake the market. Keep in mind that last earnings season, the S&P, I'll just shift back into a quick S&P chart. The earnings season that we're referring to, that we're about to experience, occurred in this time frame here. So this is where the likes of Meta reported, and we had this large gap down after a pretty decent rally from a capitulation low. We also had another sort of retest. And I believe this was some secondary effects that occurred in the market, but a retest, bit of a double top, some larger gapping structure. That's indicative more of the type of after-hour price movement we're likely to experience. And then, of course, a new sell swing that occurred thereafter. So it's that relative period of high volatility, markets pricing it in, trying to prepare for the week ahead, and also just looking at where we sit. The market last week was looking at a possible weekly higher low. If we just looked at Wednesday, this candle was sitting somewhere up here. We actually had a nice weekly sort of bottoming tail, and we had the weekly bounce potentially becoming set, the weekly higher low potentially becoming set. Now, this is why it's important to wait until your candles close. All of that changed in a matter of 2 days. We topped out on Wednesday or Thursday, I think it was Thursday, and then we completely reversed. So the picture here is obviously much different than it was a couple days ago. What used to be that potential, preliminary support, this upper resistance that we're trying to hold, trying to find some relative support mid-range, that is no longer really the picture that the S&P is portraying. The downside does look imminent. We do have some expected move definition down in the 4130s. And overall, as we move into earnings, those movements are going to be what impact the technicals moving forward. Basically, what's on the chart now can easily be shaken, stirred, and spit back out in a different way after this week is over. So prepare for the volatility this week. As an intraday trader, you should be looking to anticipate larger moves, expect for wider price action. So you're going to see potentially a little bit of whipsaw if the market tries to stabilize. But overall, you should be expecting bigger moves. Last week, that was important to note. And obviously, it was a bit surprising to see this full transition from top to bottom. But this is some of the price action that we might get moving forward. This is S&P moving 10, 12 points in a day. That happens during volatility. There are similar size candles in these ranges. And you're also just looking at bigger back and forth trade. Additionally, keep an eye on volatility futures. We'll obviously keep looking at it this week as things change and as they evolve. But if we go back into backwardation, if the market continues to expand inside of vol futures, backwardation becomes both a risk and an opportunity moving forward. Usually when the markets go into backwardation, it tends to represent a bit of max fear, max pain, a lot of uncertainty. Usually that comes to an extreme. You'll find moments in time where the market gets too extreme to support that type of price activity. And obviously this marks significant lows. Doesn't mean it's the absolute low. That's important too. These are all tradable events in time, but until we get there, the market may see lots of pretty wild trade moving ahead. So with all that said, I just wanted to highlight how bad things got last week from a sector performance. And this is not going to be something that's going to be super evident from the chart, but I just want to focus in on the last couple of trading sessions. If you were watching Advanced Decline last week, during the end of the Friday session, we had a fully correlated market to the downside. I don't have a screenshot, unfortunately, but at one point, the S&P and the NASDAQ were trading pretty much 100 stocks to the downside, 0 stocks to the upside. I think Lockheed Martin was the only green stock on Friday's close. Obviously, that could have changed near the end of the session. But no matter where you looked last week, technology was down. Healthcare, one of our lead bulls, sold, changed the trend, no longer a bullish candidate. Discretionaries down, similar to the S&P. Energy, lead bull candidate, seeing selling from the top side. Staples, overextended, seeing selling from the top side. Materials, possible breakout, similar to healthcare, set up very similar, massive sell swing. And the list goes on. Industrials, utilities, there was basically nowhere to be a bull. The market was fully correlated. What this means is that we can see this occur again, but it can often be moments in time of relative extremes. So if you see certain signals, this can provide opportunity, but understand that last week, things changed. Things correlated to the downside. And over the last 2 sessions, really, there was nowhere to be a bull in the market. So let's move forward with that perspective and understanding that the market may continue to act this way for a period of time. Earnings are on deck, so that's going to be good intraday trade. And as always, trade safe. We'll talk more about this over the next couple of sessions and obviously prepare for the expectation of movement for these mega cap companies. So as always, we'll talk more then. Stay tuned for pre-market prep.
All right. Good morning, my friends. Welcome to the pre-market prep. I hope everyone is having an amazing morning. Hopefully, you guys are having had an incredible weekend. Good morning, Norm. How you doing today?
Hey, good morning, buddy. I'm doing well. How are you? How was your weekend?
Doing good, man. Weekend was great. Good time with the family. Time to kind of relax a little bit and get ready for the markets again. And we're back here, man. So pretty good. Hopefully, yours was good as well.
Yeah.
Um, Yeah, guys. A lot of action going on this morning, as you can see, to start off the week. But before we get into all of that, let's give Jared a big thumbs up, guys, for engineering the markets every Monday through Thursday at 8 a.m. So make sure you hit that like button for him. We appreciate him very much. All right, guys. Norm, the elephant in the room, right? Twitter and the market. I mean, is there anything else to talk about besides those two starting out today?
Looks like it's going to happen, man. Apparently, there was a meeting. Well, there's no economic data coming out today, so we can skip over that part. We've had a
Mhm.
nasty couple of days overall in the markets. We'll get into Twitter in just a minute. It is on our gap up list, but the SPY, you can see those if you switch back over to that, the two big red candles there. Jared was just talking about how essentially everything was red on Friday, similar on Thursday, but it developed and got worse on Friday. To be frank, I'm a little bit surprised we're not gapping down more than we already are, but who knows? Who knows what's in store? Um, Really, the big undercurrent this morning is China. Concern over some more lockdowns over there. That's pushing, you see almost everything Chinese on the downside, all the ones we're familiar with. And then a couple of other things. You've got oil down almost 5% this morning. I believe gold was down, and metals and such were down a decent amount, 2%, which is quite a big drop for gold. Um, and other commodities. So yeah, let's see this where this week takes us. We've got some big earnings this week. Um, Apple is Thursday to name one, but
Yeah, speaking of earnings, there are some big tech
look at
names
that.
as you can see here.
Apple,
Hmm.
Amazon, Facebook, all the big oil companies at the end of the week. You got Intel on Thursday. Coca-Cola reported this morning, better than expected there. Microsoft tomorrow, Google, yeah, aka Alphabet. So big week for earnings. We'll see how it goes. Somebody's at your front door.
Yeah, they're not getting in. They don't have a key. They're not getting in because I'm not getting up. We're doing our thing this morning.
I know that
Um,
sound
and
makes the
everyone
dog
that knows
bark.
me, they know that this is what we're doing. So they're not showing up at this time. So, or at least anybody that's important. Guys, welcome. Let's get to it, guys. So a lot going on some big names and how the overall market is doing, especially on the tech side. A lot of big tech names, a lot of big names here. We cannot wait to see how we're going to end this week. Is it going to add to this already bloodbath that we're seeing on the spy, or are we going to recover a little bit? Hopefully, some of these big giants report some good stuff. But more important news than anything else is that Artie, our friend Artie, agreed. And if you have not, if you don't follow him on Twitter, you should. He agreed to
Absolutely.
grow his beard. I don't know his exact handle, but we'll get it in a second. He agreed to grow his beard into we are in a bear market. I think we have to kind
I
of
told him not. I told him not to do
you
that.
warned them. You warned them.
It's a bad idea.
And I think we got to make it a little more concrete. What does that mean? Does it mean we hit a new all-time high? Like, what's the concrete level for this? So as we go through the show, guys, throw some ideas out. We'll figure that out, and we will go get back to that before we end the show. All right, let's get to it, guys. Scappers list this morning,
By
quite a
the way, his
bit.
handle is at
Yeah. Mhm.
Ardi ARDI underscore Aziznia AZIZNIA. Yeah. For those of you that were not around when COVID hit, I didn't grow. I pledged I wouldn't shave until the VIX was back below 25.
Yes.
Um, it
I,
was
I, I
multiple months and very annoying.
It was some time ago. Did that
And
note ever
that we
stayed
got
on
the
there?
surprise bounce.
Yeah.
Everybody thought they're shutting everything down. The economy's going to go to hell. I got off lucky, but
You did.
it felt like forever.
Oh yes, yes. Um, all right, guys, let's get to it. Gappers list this morning, quite a stuff in the red already, as Storm mentioned. We're gonna go through some of those, and I'm just gonna reset something here, guys, to make sure we get some tickers at the bottom. We'll figure that out. All right, guys. Let's get to it. I'll go ahead and remove our watch list from last week. Let's clean this up, and we'll start with NKTX this morning. So NKTX here on the list. This is a 19 million shares flow. So low flow for today, looking really really active right now. Started
For sure.
at a $8, right? $15 now.
Yeah, they had drug news that dropped. This is a biotech. I believe it came out late on Friday, and I know there's a conference call. I don't know when. Let me see if I can figure out when that is. It's this morning. It's going on right now, actually. So there's a conference call about cancer treatment going on. They had some positive phase 1 news that dropped, so they're getting a big pop on that.
All right, so we'll definitely be in play today, guys. Low flow of the day for sure right now, up 80% almost and climbing. So take a look at HIG. This is what is this here? It's not looking good. Looks like a block trade, and then you're not really getting a whole lot of action here. So I'm gonna skip on this one, guys. Yeah, no good.
No.
Yeah, no good. We'll move on to SIMO, and this one is also not looking great. It is a 5.7 Silicon Motion Technology, looks like 142,000. I don't like the way this looks today. I think we'll find better stocks in here. Let's look at L. L this morning. Another one seems like not even a block trade, just a couple of 125,000 shares traded today, but not really in play.
No bueno.
Yeah, and the elephant in the room, Twitter, guys, again this morning looking really, really nice. Up 4.87 million shares traded. Now, the only concern on Twitter is that we have to wait for it to settle down. We know how choppy it can be at the market open with all this volume. We saw that a couple of times when we did have a big pop like this. So let's be patient with it, right? But definitely in play today. Yeah.
The word is that Elon and the Twitter leadership met yesterday, and rumor is Reuters is reporting, I guess I should say, that they have agreed to be taken over by Elon Musk at his 54.20 bid. So,
all right, there it is. So now it's being reviewed to see if there's any issues in actually getting this going. So yeah. Let's see, guys. Looking good right now. There's for those on YouTube, there's Artie's handle was just sent, so you can sign up there or follow him there. So Twitter's looking good, guys. Let's look at what's gapping down today. PBR this morning, they are not good. Down to 3.2. We used to trade this a lot, or at least have it on our list quite a bit in the past. Hasn't been so lately. So I'm not liking what I'm seeing right now. They're leading. No, I'm sorry. They're not leading the gappers list. I was about to say. I'll scroll down.
You must have been scrolled or something.
Yeah. There's better stuff out here with much higher percentage. Let's start here with AXSM. This one's down 23%, guys. 414,000 shares traded. We know the stock very well. It's on our gappers list more often than a lot of these other names, and it doesn't trade very well for me personally. But they are in play today. That's a big gap down. Is that earnings? What is that? No, earnings is actually second. So something else is up with these guys.
Yeah, I mean, it's a biotech stock. I don't have the specific story on this one, but some negative drug news.
I'm going to put it on here, guys. Typically, they don't trade very well, but we'll put them on here just for now. That's a big drop for them. GOSS this morning, horrible pre-market activity, not looking good at all. Lower price stock. They could add a R there, and this is more gross than anything. So I'm gonna just move on down to DWAC this morning.
Gross.
Yeah, that's gross. This is just not good at all. DWAC this morning, guys. They are they are looking. Pre-market actually is not bad on this one though. Very light volume, but not horrible, right? Not great, but not horrible. And again, they're in interesting times. Every time Twitter pops up, these guys take a hit. So they're down 6.6 this morning after taking a couple of big drops in the last couple of days. We'll see where this goes here. Has definitely not been fun for these guys. I'm not sure what their IPO price was, because I know were they a SPAC before, Norm, and then they kind of right. So hard to tell what the actual IPO was. Maybe here, who knows? Either way, they're not looking good this morning. We had them on there. All right, a couple of Chinese stocks coming in here. Here's Futu. just too light on the volume right now. I think the daily looks very interesting. I think you have a couple of levels here you can head towards if the overall Chinese stuff is going to be weak today. But for the most part, I hope to find something a little bit better. BHP today they are down
No, no,
4.6. You know, it's what this is more like this is the oil stuff, right? So
no.
what do
This is mining.
this is mining. Okay. So I'm just not sure. I see a lot
It's
of other
down with
mining
all
stuff
the
here.
metal stuff are getting
Yeah,
hit.
yep, I see that. So I'm not a big fan of these guys. They have once in a while traded well. BHP, by the way, look at the last couple of days, just getting crushed here. But again, I'm just not a fan of the way they trade. Same thing with AG. I see gold in here as well. Same thing with those guys. I'm not gonna add them to my list. Maybe there's an ETF that's better to trade. Is there a good ETF on that? I'm sure there is, but maybe that would be the way to go today. LI this morning, not looking all that good right now. Very light on volume, down 4.6. We'll have to just wait, give it a little bit here. Here is Becky, guys, down 4%, 111,000. Again, just they're all down, all these Chinese companies, but they don't have great volume. Maybe we have to wait for the market over to just kind of get these going. We have Oxy coming up here. This could be a good one for today. Yeah, I think Oxy would be nice to keep an eye on, especially with the way the market is trading. We'll keep an eye on that. We have Baba, probably one of the better Chinese tickers. See, I'll watch Baba for sure. You could tell it has better volume. It's down 3.3. This is one that I will keep on my list because I know there's a higher chance of this one trading better than the rest. So I'll keep that one on there. Just gonna scroll down, see if there's any interesting names here. What is Tesla, Neo? What else we have in CCL doing? Let's check those and then we'll get to the room here. So let's go to Tesla right now. Tesla, yeah, Tesla's good. Heavy volume. Look at this beautiful level of support here that we have. So yeah, I'm adding Tesla to our list. Let's take a look.